In today's video, I'm going to share with you 4 simple things you can do to increase your Social Security benefit in retirement. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. When you understand how Social Security works, how it's calculated, what it's based upon, the factors that go into it, you can really quickly start to understand how you can get the most out of this system when it comes to maximizing your income in retirement. So before I share with you those 4 simple tips that you can use to immediately start impacting or increasing your Social Security benefit, I want to take a quick second to explain to you how Social Security works. The first thing that's important to note about Social Security is how it's funded. So if you look at your pay stub, you'll notice there's federal taxes. Now, depending on what state you live in, there might also be state taxes. And then finally, there's something called FICA taxes or payroll taxes. Those are the taxes that you're paying that go to fund Social Security. So Social Security is not funded through the traditional federal income taxes or state income taxes. They're funded specifically through payroll taxes. Now that payroll tax for Social Security specifically is 6.2% of your income up to the first $160,200 that you earn for 2023. That cap increases a bit each year, but for 2023, it's $160,200. Now, on top of you paying 6.2%, your employer is making matching tax payments of 6.2% of any wages up to that threshold. Now, there's also Medicare taxes that are factored into FICA taxes, which is an additional 1.45%, but that's going to fund Medicare, not Social Security. But the first thing to note is the way Social Security is funded is through this special tax on the first amount of dollars that you're earning that both you pay and your employer is paying. The second thing to note about how Social Security is calculated is it's based upon your 35 highest years of earnings. You might look at that and say, well, my goodness, I'm earning a lot more today than I was 20 years ago or 30 years ago. Social Security takes that into account. And in fact, they're going to index these earnings for inflation. For example, the Social Security tax today is taxed on the first $160,200 that you earn. 30 years ago, in 1993, that cap was at $57,600. So in other words, to fully max out your Social Security benefit for the year 30 years ago required you to earn $57,600, whereas today, in 2023, you'd have to earn $160,200 to fully fill up that base today. So if you look at all of your earnings, Social Security applies an inflation adjustment to it, and then they're going to use the highest 35 years of earnings in calculating your benefit. Now, if you have a year where you're not working, or let's assume that you only work for 30 years, they'll simply use 0 for those 5 remaining years. So say, what are your earnings? Did that fill up all 35 years? If not, they'll factor in 0 until they get the highest 35, and that's how they're going to calculate your benefit. Another couple things to note is earnings are means tested. What do I mean by that? Well, let's assume you have one person who earns $160,200 and you have another person who earns exactly half of that, so $80,100. Let's assume they both did that on an inflation adjusted basis for 35 years. Does that mean person 1 gets double the benefit of person number 2? No. And the reason for that is Social Security is means tested. What that means is the first dollars that you earn are weighted more heavily in terms of the calculation of what Social Security is going to give you. The exact dollar amount for 2023 is the first $1,115 that you earn. 90% of that is included in the determination or the calculation of your Social Security benefit. Any amount from $1,115 to $6,721, 32% of those earnings are going to be factored into the calculation of your Social Security benefit. And then finally, any dollars earned above $6,721, 15% of those dollars are going into the calculation of your Social Security benefit amount. So it's almost like a reversal of our progressive tax system, where our progressive tax system says the first dollars that you earn, they're taxed at a lower rate than the higher dollars that you earn. Well, think of the reverse for Social Security. The first dollars that you earn are weighted more heavily in terms of your calculation of your Social Security benefit. The last dollars that you earn have a lesser impact on your Social Security benefit. That's important to note, and I'll share why in just a bit here, but that's how Social Security is weighted. So if someone has literally half the income of someone with $160,000 or $160,200, they get more than half the benefit of Social Security at full retirement age. Then the final thing to note is you have what's called a full retirement age. For most people, it's between 66 and 67. If you were born in 1960 or later, your full retirement age is considered 67, and if you were born before that, it starts to drop a little bit. That's not the age at which you have to collect Social Security, but it's the age at which you have your primary insurance amount or your full retirement age amount. You can collect as early as 62, and you just take a reduction in benefits for doing so, or you can collect as late as age 70, and every year you wait after your full retirement age, your benefit goes up by 8%. So that's the framework that we're looking at. That's the foundation that we're looking at. When we understand that, if that's how Social Security is calculated, now we can start to see how can we make the most of the system to maximize your income in retirement. So with that being said, what can you do to start increasing your benefit? Well, number one is simple. Work a full 35 years. Now you may hear this and say, oh my gosh, that's a lot to ask. Maybe I've worked 30 years and I'm really wanting to retire. 5 more years seems like a lot of work. Well, remember what I said. The first $6,721 that you earn for 2023, that is weighted more heavily in the calculation of your Social Security benefit than any dollar amounts above that. So it's not saying work 35 years at your current position, earning a high income and a stressful job. It's saying just put the work in to at least fill up that bucket. What that's doing is it's more heavily weighting some of those years so you don't just have a $0 benefit show up in the years that you're not working. So this doesn't have to be full-time work. This doesn't have to be income at a really high level. Can you do something just to pay a little bit into the system to start squeezing out the most you can get for your Social Security benefit? Number two, the second thing you can do is wait longer to collect. Now, as I mentioned, age 66 to 67, that's going to be considered your full retirement age amount. Every year that you collect before that, depending on what year it is or how far out you are from your full retirement age, you're taking between a 5% and a 6.67% reduction in your benefit. Now, the way that that works is every single month, it's actually a prorated amount of that, but the earlier you collect, the less of a benefit that you're receiving. Social Security is looking at that and saying, okay, if you're going to collect early, that's fine, but we're paying you over more years, so we're going to pay you a reduced benefit. And from an actuarial standpoint, their goal is to say, can we pay you approximately the same amount regardless of when you collect? But if you have high life expectancy, or if you want to plan for many years of income, the longer you delay, the more that benefit goes up. The nice thing is, as I mentioned, between 5% and 6.7%, that's the reduction in your benefit if you collect before your full retirement age. If you wait after full retirement age to collect, you get what are called delayed retirement credits. Your benefit goes up by 8% per year. It's simple interest, but from your full retirement age until age 70. And at age 70, your benefit's no longer growing, so you might as well collect it at that point. But the longer you wait to collect, the more benefit you're going to get in your Social Security income. The third thing that you can do to maximize your Social Security benefit is to understand how a spousal benefit works. Now, when you go to apply for Social Security, you're going to have two options. Number one, you can collect a benefit based upon your own earnings record. So your 35 highest years of earnings, looking at inflation indexed amounts for each year that you are working, Social Security calculates that benefit and says, here's what you're eligible for. Now, on top of that, you are also eligible for a spousal benefit if you're married. Now, a spousal benefit, that is half of your spouse's benefit at their full retirement age. Now, keep in mind, this also applies to ex-spouses. So if you were married for 10 years or more, even if you're no longer married, you're still eligible for a spousal benefit. So when you look at that, the math says, what am I eligible for? There's two options here. What's 100% of my benefit? If that's less than 50% of my spouse's benefit, I'm going to collect the spousal benefit. Where you oftentimes see this is if one spouse stayed home to raise children, or if one spouse didn't earn quite as much, and you look at their statement, probably not much of a benefit there. The good news is if their spouse was earning and paying a lot into the system, they're eligible for up to 50% of that benefit. So understand how that works, because even if you've never paid a dime into Social Security, if you have a spouse or an ex-spouse who has, you're eligible for a benefit based upon their record. And then finally, the fourth thing that you can do to maximize your lifetime Social Security benefit is to understand how survivor benefits work. We just talked about a spousal benefit. A spousal benefit is a benefit that you are eligible for while your spouse is still living, and it's 50% of their full retirement age amount. Now, if your spouse passes, and again, this could even be an ex-spouse that passes away, you now become eligible for 100% of their benefit. This creates some really interesting planning points. Those planning points are, let's assume that you're a widow or a widower, and you have the option of choosing your own benefit or a spousal, or I should say a survivor benefit based upon your deceased spouse's earnings record. Well, you can play a game with the system, and it's not really a game, it's just the rules of the system, where you can say, for example, maybe I'll collect a survivor's benefit from now until age 70, so I'm getting some immediate income. All the while, my own benefit is continuing to grow, so that by the time I turn 70, I switch from the survivor benefit to my own benefit. Or maybe you do that vice versa. Maybe you collect your benefit first, allow your survivor benefit to continue growing. But regardless of which way you do it, you need to understand how a survivor benefit works, because when you're making a decision to retire, and there's two of you, you need to understand how is Social Security going to maximize our combined income while we're both here, but also how can we protect a surviving spouse if one of us predeceases the other by some significant margin of time. So I hope that's helpful to understand. Once you know how Social Security works and the rules of the system, you can start to see how you can get more out of your benefit by working it in a way that's going to maximize your lifetime benefit. Now, we never want to make Social Security decisions in a vacuum. We want to understand how will decisions with Social Security impact things like taxes, retirement income, investments, and more. To see how you should coordinate Social Security with your withdrawal decisions from your portfolio, be sure to check out this video here. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.